What's up guys, and welcome to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. Before we get into the video, please note that we are not financial advisors and this video is for entertainment purposes only. Today we're going to look at recent developments at Lordstown Motors and what it means more broadly for the EV sector and SPACs. Lordstown has been having a pretty rough month with its stock price being cut almost in half over the past 30 days. Part of this can be attributed to the broader market sell-off, but there are also a few important company-specific drivers of the decline. On March 12th, the famous short-selling firm Hindenburg Research published a report accusing the company of misleading investors with fake order numbers. This news caused the stock to drop 16% on the day. A few days later, on March 18th, Lordstown disclosed the SEC has opened an investigation to look into whether Hindenburg's allegations are true. Even if you are not invested in Lordstown stock, this is an important story because it may be indicative that markets have gotten ahead of themselves over the past year, especially in EV stocks and SPACs. Lordstown Motors got its start in November of 2019 when they bought an abandoned GM factory in Lordstown, Ohio. In March of 2020, they paid fellow EV company Workhorse $12 million as well as a 10% equity stake in exchange for their intellectual property of the Workhorse W15 pickup truck. With this technology, they designed the all-electric endurance pickup truck, which they plan to manufacture in their Lordstown plant and start deliveries in 2021. Automobile manufacturing is an extremely capital-intensive business, as it can cost hundreds of millions of dollars to get a full manufacturing plant up and running. Being less than 1 year old and not having any sales, it would be very difficult to convince institutional investors to give them money on a traditional IPO. So instead, they raised money by merging with a SPAC in summer of 2020. With Tesla and NIO reaching all-time highs at that time, there was a lot of hype around EVs among retail investors. This EV craze led to a tripling of the stock price in the months following the deal's announcement. Lordstown stock has always been volatile, but investors became increasingly bullish over the past few months as the company's prospects appeared to be strong. On January 11th, they published an update saying that they have booked more than 100,000 pre-orders for their endurance electric pickup truck. This was an extremely bullish update and caused the stock to pop more than 20% in just a few days. However, Hindenburg Research recently published a report on Lordstown accusing the EV maker of misleading investors on multiple fronts, in particular in regards to its demand and its production capabilities. They focus heavily on the demand and pre-orders of Lordstown trucks, which they say are mainly non-serious pre-orders that have little chance of actually converting into real orders. One of the sharpest accusations is that one major deal that Lordstown recently announced for 14,000 trucks and worth $735 million is actually from a company that is based in a small residential apartment that Hindenburg thinks does not have the means to actually place the order. Another order for $52 million is supposedly from a startup that Hindenburg has talked to and said that probably wouldn't actually end up buying any trucks. Hindenburg then goes on to list several other orders, and even a scheme by a consulting firm where they would try to generate pre-orders for Lordstown, where all the people they listed said that they had no intention of actually buying all the units they pre-ordered. The short report then attacks the legacy of the founder and CEO of Lordstown, Steve Burns. They say that they spoke to multiple former senior employees of Lordstown, who said that the CEO was a con man who engaged in questionable business practices on a regular basis. One person they talked to said that the CEO had previously worked at Workhorse, another EV startup. After wasting money for research and development and continually missing deadlines, he was ousted from the company and subsequently started Lordstown Motors. Additionally, Hindenburg reports that the development of their trucks is not going as well as it seems. They say that Lordstown is probably still years out from actual production, according to a former employee. Additionally, their battery production, while supposedly will be done in-house, is currently being done by hand due to their battery pack equipment still having months left before they arrive. Their first actual road test was unsuccessful and ended up in a fire in a 911 call. Finally, Hindenburg points out that in the 4 months since the company went public through a SPAC last October, senior employees at the company have sold tens of millions of dollars worth of stock. That may suggest that they do not think that Lordstown is on track to do well in ramp production. So the main points in the short report were that the reported pre-orders are misleading. On Wednesday, the CEO of Lordstown acknowledged in an earnings call that they are being investigated by the SEC in regards to the Hindenburg report. In the interview, he said that Lordstown, as a pre-production company, had never claimed to have actual orders, and that they had not tried to convey that there were real orders at the time. Take a listen.
Be clear here, the way that you have characterized your pre-orders or reservations in the past, I mean, you called these on CNBC serious orders. Now, people would look at this and say, if you have a company that's not putting down a deposit, that doesn't have a fleet, but basically are collecting letters of interest, are those truly serious orders?
Well, no, Phil, we've always been very clear, right? These are these are just what they're intended to be, right? These are non-binding letter intents. They're called pre-orders out in the kind of real world. So always classified them for that, and we have a lot of those pre-orders. I think we have pre-orders directly from fleets. We have pre-orders from people that sell to fleets because that's the way fleets buy. Fleets don't buy like, in general, they don't buy like consumers buy. They buy through intermediaries. And so all we've done is gone out, gauge interest, because you got a tool to build something like this in an automated fashion. We're going to build one of these every 6 minutes. We kind of have to know how to tool, and you got to know about a year in front of your building. So that's what everybody uses pre-orders for. They are always, by definition, non-binding, no money down, cancelable. I mean, that's just that's the nature of EV startups trying to gauge interest.
I understand that, Steve, but some people would look at this and say, look, you were far more aggressive in characterizing those pre-orders as true commitments, that you have company XYZ that has said, yeah, sign us up for 5,000 or 6,000. Do you regret the way you characterize those reservations?
Well, reservation, Phil, all I can, I don't want to get into the specifics. All I can tell you is demand is robust. We've never said we had orders. We don't have a product yet. By definition, we can't have orders, right? So when you're early and you're years away from a product, in this case, 1 year, and now we're down to 6 months. So now that we have the betas, we are starting to be able to shore some of that up. But the pre-orders did exactly what they were supposed to do, gauge interest. Nobody knew if fleets would buy an electric pickup truck, right? It was completely unknown science, no data around it. So we queried them. We have very robust interest, and that's just what they are. They're letters of interest. You can't do any more of that in this stage. So I don't think anybody thought that we had actual orders, right? That's just not the nature of this business.
There are two sides to every debate, and you can't just blindly trust short-selling reports. When a short seller publishes a report, they are usually already short the stock and stand to benefit when the stock goes down. This gives them a pervasive incentive to over-exaggerate the short case, and in some cases make up erroneous allegations against the company to push the share price down. One example of this happened in 2019 when accounting consultant Harry Maropoulos publicly accused GE of committing fraud and claiming that the company was on the verge of bankruptcy. He was working on behalf of an undisclosed hedge fund that was likely short GE stock before he made the claim and wanted to manipulate the stock price down with these allegations. While GE's business has been under pressure over the past few years for various reasons, the fraud allegations turned out to be completely false. However, Hindenburg has a reputation for sometimes being able to uncover real scams and frauds. They were the research firm that uncovered Trevor Milton and Nikola Motors for having the truck that was rolling down a hill. After the report, Nikola's stock reversed its insane run and has bled out 77% of its value since then. Although he has become a billionaire from starting Nikola, founder Trevor Milton has since become the laughingstock of tech entrepreneurs, as well as the target of accusations of a history of fraud. SPACs are often good for retail investors as they allow an opportunity to invest in early-stage companies that otherwise would only be accessible to private equity firms. One example of a successful SPAC is Virgin Galactic. Even after its recent correction, shares are still trading at more than triple the initial SPAC price of $10. But you must be very careful with SPACs as they bypass the extensive due diligence processes associated with traditional IPOs. Here's Lloyd Blankfein, the former CEO of Goldman Sachs, talking about the risk associated with SPACs.
In the case of SPACs, here's the phenomenon. You're getting companies public, but you're getting them public in a two-step process where one of the elements of an IPO is dropping out. That is the discipline of IPO diligence plus underwriter liability. When this initial SPAC goes public, you're scrutinizing a shell company, possibly the reputation of the sponsor. When that company then de-SPACs and mergers, it's a merger. It's not an IPO that carries with it a lot of diligence obligations, and it's not the same kind of liability for an underwriter. There is no underwriter of that. And people talk about, well, it's more sophisticated, but we understand when something goes wrong, nobody in hindsight was ever sophisticated. And so these things, there are going to be things that are going to go wrong. Things are not going to work out well. There's other collateral issues like, is anyone incented to really drive down the price of what they're acquiring? Because the SPAC sponsors may be incented to get a deal done and maybe not drive the price as hard as they otherwise would. The person, the company that's going public wants to drive it. And then in the absence of diligence, that's going to be what will happen. If a few of these go bad or they were overpaid and some people made a lot of money and investors lost money, people are going to say, where, you achieve the economic equivalence of an IPO, but where was the process and diligence that we all associated with a rigorous IPO diligence process? And that kind of drops out. Now, I'm not saying that they're all bad or that any of the ones that you could bring up are bad. Some of these won't work. And my advice to people who are doing this now would be really, really diligence, really, really document. But, again, in hindsight, if something goes bad down the road, people will look back and, show trials to follow.
Alright guys, that wraps it up for this video. If you like this content and want to support the channel, consider becoming a channel member. Members get access to all of our non-time sensitive videos one day in advance and will be able to vote on which topics we make videos on. If you don't want to join as a channel member, you can still help us out by smashing that like button, and you'll still get full access to all of our videos. Also, don't forget to check out our second channel, WSM Research, where we post due diligence on high growth and innovative tech stocks. As always, thank you so much for watching, and we'll see you in the next video. Wall Street Millennial, signing out.